Hello, and welcome to our ESG briefing, Financial Markets Double Down on Sustainability. We are going to be talking today about what the markets are doing in the last 6 months of the COVID pandemic and what that means for companies, public, private, big, and small. I am Jennifer Woofter. I'm the founder and president of Strategic Sustainability Consulting. I'm especially excited to talk with you about this topic today. I started my career off in investing, working for the Calvert Group, which at the time was America's largest family of socially responsible mutual funds. So I got to see the ESG from the investing side. And then for the last 15 years, I've been working directly with companies to identify, manage, and communicate about their environmental and social risk. So here's how it works. We are going to focus on a 25-minute briefing. And then for people who are watching live, we'll say a couple minutes at the end for Q&A. Because of this condensed time frame, we're going to go rapid fire. We're not going to get too deep into the details. What we're really looking for are the trends and what those trends tell us. So speaking of trends, the topic today really is embedded in this larger context of 4 major mega trends that are impacting the way that environmental, social, and governance issues are handled. The first one is investors, how the financial markets are responding. The second one is customers, who are increasingly requiring ESG and sustainability components in their supply chain. The third mega trend is regulators, really tightening the reins on what companies, publicly and privately held, need to do to be in compliance with the laws and regulations. And then the fourth megatrend is a sort of a slow burn one. It's a longer one. It is this idea that employees, especially the millennial generation and the Gen Z generation that is coming now into the workforce, want to work for companies that align with their personal values and, in fact, will even take a pay cut to do so. So we're going to talk about that first trend today. So what we've seen this year is, even with the pandemic, the ESG momentum is growing at all levels in the financial markets. This is happening at the individual investor level, so that's high net worth individuals. It is also just regular people who have 401ks. There is still this idea that people want to have their investments aligned with their personal values, and increasingly those personal values are around sustainability. The second element is institutional investors, including now mainstream funds, are now increasingly looking at sustainability, not just as a values component, but now also as a business risk. And then responding to these pressures, we now see companies across the board pretty dramatically increasing their sustainability reporting and disclosure. At the same time that the overall quality of information is increasing, the quantity is actually taking a step back. And you can sort of think about this as the pendulum swinging back, that for a while the message was disclose, disclose, disclose. And that's how we ended up with 800-page sustainability reports. Now the focus is really on stepping back, and instead of carpet bombing people with just every piece of information they could want, is really finding the most appropriate ESG indicators to communicate, the ones that are most tightly tied to financial materiality. So the question is, though, why now? Like, why are we talking about this now? And we need to sort of step back and put this in a wider context. That the first wave of socially responsible investing really kicked off in the 1990s. By the early 2000s, $1 in $10 was it held in some kind of ethically screened fund. A lot of times that was like exclusionary. So we didn't want to be invested in tobacco or nuclear weapons or gambling or pornography. But with this rise in activist shareholders, now we're also looking at positive criteria. So that is, does the company really understand and taking action to effectively mitigate its climate risk? Is the company really being proactive about human rights and the risk of conflict minerals in its supply chain? Things like that. And this real focus, the piece right now that is hitting us hardest, is this climate risk. So yeah, this has been building over the last 20 years, but we're starting to see it come to a head. And in 2019, we started to see the first real indicators that this was getting serious. So Goldman Sachs has been preaching about ESG and sustainability for more than 10 years. They have had a dedicated team dedicated, for ESG issues, working on ESG issues. But in December 2019, they announced a plan to spend $750 billion investing in ESG issues with a specific focus on the climate transition. So I think the big takeaway here is that previous to this, a lot of financial organizations and accounting firms like the Big Four, Deloitte, KPMG, Ernst & Young, Goldman Sachs had been talking a good game on ESG, but this is one of the first times where we saw them putting their own money where their mouth is. And this focus on climate transition was just a sneak peek of what was to come. January of this year was the real tipping point. And this is when Larry Fink, the market whisperer, he's the CEO of Blackrock, which is the largest asset manager in the world with $7.4 trillion in asset under management. Larry Fink every year in January writes a letter to CEOs that sort of says his perspective on where the markets are going. He said in this letter, sustainability should be the new standard for investing, and specifically made some commitments around how BlackRock was going to be incorporating ESG into its investment strategy through a couple different avenues. So this was like the big heads up. When Larry Fink speaks, the markets listen. And so we also saw some other things. So for example, here in February, CNBC is reporting that green bonds continue to be hot with more than 25% growth. We're starting to see ESG criteria creep into hedge funds, which historically have been very resistant to anything that has a whiff of morality or, doing things because they're the right thing to do. Hedge funds are driven by what makes money. And the fact that ESG is now an increasing element of hedge fund strategy is really showing us that this is widely dispersed and beginning to become embedded across all different financial tools. MSCI has identified ESG as one of their major trends, specifically, again, you're going to hear me say this a lot, climate risk, that they are now seeing climate risk as key to shareholder returns. Not just about operating expenses, not just about reputational risk, but really about tying it directly to shareholder returns, including dividends, stock buybacks, like the whole shebang. They're also identifying ESG as tied to terms of capital. So while I think a lot of times we talk about ESG for publicly traded companies, how it impacts the stock market and things like that, here we're also seeing it as if you want money, even if you're privately owned, if you are going for financing, increasingly ESG is going to be a component of the terms and conditions associated with access to that capital. And this is a great example of where sustainability is going to impact you, whether you're big or small, private, public. And then sort of this evolution is this third trend, this evolution of shareholder activism. That really is about accountability and is much more closely tied to business risk, very much less about avoiding apartheid in South Africa or getting out of tobacco or not being part of the nuclear energy rush. Those things I think got us started, but now it is, what does your 10 or 20-year outlook look like if you can't access your assets because they're stranded as a result of climate change? Okay, so we started off good, but then of course we know what happened in March, right? Is COVID hit and businesses shut down, employees were furloughed, there was this huge upheaval. It felt like everything got put on the back burner while we wrestled with the impacts of the pandemic. But in fact, if you look at the financial markets over the last 6 months, so March through October, what we're actually seeing is the markets doubling down on sustainability and ESG. So why is this? I think there's three things really. Is the first one is For a long time, sustainability practitioners had been talking about the fact that sustainability is sustainability plus globalization equals major shocks to the system. That instead of a drought or a hurricane or a human rights problem at a single facility, now a problem in one part of your supply chain is going to impact everybody, and a problem in one area of the world is going to impact everybody. And now when we have issues like this, I think COVID is a fantastic example. It started in one place, spread everywhere, and just is exponentially impacting us beyond what most businesses had prepared for. This is a great example. People are pointing at this and saying, look, this is the first of many impactful waves that we're going to see around climate change, around changing pandemics, around political upheaval, all tied to environmental and social criteria. There's this feeling that a lot of companies sort of kicked the can down the road, making sort of improvements on the margins. Sure, we'll upgrade our LED lighting. Sure, we'll publish a conflict minerals report. Sure, we'll calculate our carbon footprint. But really, businesses to date have not truly wrestled with the impact of sustainability on their business model. And I think COVID is like this sort of come to Jesus moment where we're saying, look, these big things are happening and we need to get ready. We're also starting to see now in alignment with the UN Sustainable Development Goals. So this is really where government from the top down has said, here's 17 sustainability criteria for the world to consider. And companies are now saying, here's how we align with those 17 issues, and here's where we can be playing a part. Okay, so CNBC is also reporting by June, they're already seeing it, right? In the first 3 months of COVID, they're already seeing that the markets are not backing off from ESG, even though COVID has largely shut down the economy in other places. In fact, they're saying it's a turning point in ESG investing. That sustainable funds attracted record inflows in the first quarter amid the market turmoil, and that this is it. This is really where it's happening. Now, one other important thing that's happening simultaneously with this is that the market and the financial organizations are saying, yes, individual companies need to focus on this, but institutions also need to be looking at risk portfolio wide. So ESG risk is now being assessed at the company level. Companies are being scored through questionnaires like the ISS questionnaire, Institutional Shareholder Services, or Corporate Knights, or Dow Jones Sustainability Index, or the FTSE for Good criteria. There's all kinds of different scoring of individual companies to try to assess their performance on a variety of ESG issues. But it's also now being assessed at the portfolio level. So here's a great example. Legal and General Investment Management has about $1 trillion of client assets, has developed a new tool to model climate change risk across its portfolios. And it's rolling that out this fall to be with full rollout expected by next summer. So what this means is that companies now have double the pressure to respond, especially relative to your industry performance. So now portfolios that may be weighted with a certain percentage in different industries. Before, if you were just sort of performing alongside sort of where the average was for ESG performance in your industry, these portfolio managers may be trying to edge that out, and just a little bit better than your industry average may make the difference between investing in you versus investing in one of your competitors. This is the competitive advantage factor of sustainability that we have been talking about for 20 years. It's these type of tools that are going to make it really clear where the outliers are. So what should you expect from all of this? So Blackrock, after its big announcement in January, was criticized that it didn't actually support as many shareholder votes as it could have. But they fired back and said, look at the evidence. We've engaged with more than 400 companies. that face material financial risks in the transition to a low carbon economy. We have voted against 55 directors, and we have put 191 companies on watch. We leverage the widest range of stewardship tools in addressing climate change risk on behalf of our clients. And I think this speaks exactly to what we should be looking for. Number one is overall more support for ESG resolutions. If you're publicly traded, you need to be watching out for those shareholder resolutions to be popping up as part of your proxy season. The second piece is more direct engagement, that outside of proxy season, you will expect to have your IR team more engaged throughout the year. And the third part, and the piece that may get some companies over the hump about paying attention to this, is now they're actually tying ESG to votes against specific board members. So I think board members as a whole sometimes feel like they're a little bit immune to sustainability things, but now that it's being tied to it, nobody wants to have a big institutional investor like Blackrock recommend a vote against you. So this may be an area particularly tied to reputational risk for individual board members. So you should also be preparing for some big moves. We're expecting to see continued major layoffs, particularly for natural resource companies. Here's a great example. Just last week, Shell announced layoffs, major layoffs, 9,000 people, saving approximately $2.5 billion a year. They canceled their dividends. They canceled their buybacks. They're having to move assets around, pulling them out of the traditional fossil fuels. They're going to sell 5 of 15 refineries. This is a major signal that money, time, effort, like attention is moving away from fossil fuels into renewable energy and into low carbon areas of the company. The other big takeaway here, if you go read the whole article, I think this was from the Financial Times, is that you have people, even within the context of this article, talking about how climate change is forcing them to make really tough cuts. You have people saying, it's not a big deal, right? You have these ostriches who have their heads in the sand, and I feel like even with all of this evidence, we still see across the board a segment of the population of the financial marketplace who is still feeling like, this is a passing fad. And so we're going to come back to that in a minute because I think it has some significant impacts for what you should expect as part of your ESG journey. Another big trend we're seeing is this call for clarity. And again, this is not happening out of nowhere. We've seen this over the last 5-10 years, but nowhere near the level of intensity that we have over 2020. Here we have an example. This is coming from just last week that states that FERC is hosting states and stakeholders. So that's businesses, grid operators, Goldman Sachs, Wall Street banks, commodities traders, everybody coming to the table and saying, like, we need a price on carbon. We cannot continue to operate in this vacuum. States are moving forward on their own. Certain grid operators, companies are saying, just do it. We see the writing on the wall. It is coming. And for us to make good business decisions with sustainability in mind, we need clarity from our regulators. And so while you have sort of the push, the regulators, especially in Europe and Asia right now, pushing the regulation, here in the US, you're actually seeing more of a pull, saying, please actually give us some regulation that will even the playing field and will not punish ESG players. The other big takeaway here is that you can't remove politics from the discussion. Climate change is what it is, right? It's science, right? And the science right now is indisputable. And if you don't believe me, stop watching this and go spend some time on Google. It is real, it is indisputable. The fact that it has been politicized and the response to climate change has been politicized is really unfortunate. Savvy business owners, even those who align with political parties that are not environmentally progressive, are now seeing that managing climate risk from a business perspective is absolutely advantageous to positioning the market both now and in the future. Okay, and then finally, harmonization. If you hear like background cheering, it is everybody who's been working in sustainability for the last 2 decades saying, finally, there has been this Wild West marketplace of sustainability frameworks and questionnaires and indicators, and now there is, in just over the last 12 months, this massive alignment process. GRI, that's the Global Reporting Initiative, and SASB, that's the Sustainability Accounting Standards Board, were the 2 main players in corporate disclosure standards around ESG, are now finally taking steps to align. In fact, just last week, they announced a collaborative work plan with the aim to get the results out before the end of this calendar year. Other methodologies, so the UN Sustainable Development Goals, the ISS questionnaire, Dow Jones Sustainability Index, FTSE for Good, Corporate Knights, etc. They're all streamlining and overlapping so that instead of requested companies being pulled in 1,000 different directions to address 1,000 different issues, there now is a much more streamlined approach of a core set of indicators that companies need to be thinking about, managing, tracking, setting goals against, and using to plan going into the future. We're also now seeing mainstream investors, so Blackrock and others, big pension funds in particular, really aligning around what good climate risk disclosure looks like, both on the qualitative strategic side, but also on the quantitative side around what specific quantitative carbon numbers need to be disclosed and how they need to be reported for more of an apples to apples comparison between companies and within industries. And what we're seeing as a result of that is now that investors are coming to that standard set of indicators. So for example, on the Bloomberg terminal, where analysts sit and can pull information across, gobs of information across everyone, having a standard set of ESG indicators on those Bloomberg terminals is, like, I can't overstate how important that is. ESG research houses, same thing. Like we're like all kind of coming together in the same huddle. We're not there yet. I would expect over the next 1 to 2 years for this process to keep rolling along, but we're past the tipping point. We're like on the downhill slope. Things are picking up speed, and we would expect that pace to stay the same or speed up. We're also now seeing this major trend from feel-good marketing pieces on sustainability. We care about the environment. We care about our people. We want to be responsible corporate citizens. We're now seeing that messaging really turn towards more science-based. So really looking at 1.5 degree and 2 degree scenarios for climate change, water risk modeling. This is now like the science of sustainability has now met corporate business planning tools, and these things are coming together. So it's not just a matter of picking a number out of a hat when it comes time to set your carbon reduction goals. I don't know, I think we should reduce carbon by 6% or 10% or 30%. Before, people were just sort of picking numbers that felt good. Now we're actually working back from what sustainability looks like and saying, what is our company's fair share? What is scientifically relevant for us in terms of carbon targets? And we're starting to see that sort of expand out into other areas: biodiversity, chemical management, land use and reclamation, and others. So what does this mean for you? Number one, this is a time of mixed messages. So for every person like me who is out there saying, look, 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 dozens of articles every week are coming out with results saying this is here to stay, there are going to be the old guys kind of in the background saying, yeah, it's another passing fad, right? Like, yeah, let's just keep going, put our heads down, let's just get through this. We got to focus on COVID, we got to focus on recovery. This is a time of mixed messages, and you're going to have to be able to push through that. Smart companies are learning how to embed sustainability and ESG in their recovery plan. It's not recover and then deal with sustainability. It is recover through sustainability. And companies that are able to manage that and integrate that into one process are going to come out head and shoulders above everybody else. The second part is this is a time to be at the table. Even if you're not ready to make major commitments yet, there is so much stakeholder stuff going on. Join your industry group meeting on ESG issues. Show up to the regulator discussions that are happening. Make sure that you're actively seeking out this information so that you're ready to act, when the moment is right. Because, quite frankly, the window of opportunity is closing. A lot of companies have already started this process. The problem is it's a bit of it's a lot of work, right? And it takes quite a bit of work to start seeing that impact. You need to get started now, because once organizations have their plans in place, they can start acting on it and seeing results very quickly. And that is going to be really hard to compete against. Get the ball rolling now. And particularly, you must start thinking of ESG as part of your due diligence. It cannot be a separate, siloed, feel-good thing like philanthropy or community, citizenship or corporate responsibility. That is old school way of thinking. It must be part of your due diligence processes. And if we were thinking about where to start, we would recommend at first that you do a desktop materiality assessment. This is a process guided by external framework to determine which ESG indicators are the most relevant to your organization. The second piece is a climate risk assessment to determine your exposure, both for risks and for opportunities on different aspects of climate change. And the third element is you need to get together an engagement plan to figure out how you're going to talk about ESG with your financial stakeholders, whether that's your investors, whether that's your bank, whether that is your private equity or hedge funds or angel investors. Really be thinking about how do we want to incorporate this and really listening for what they care about, because that should inform your strategy as well. So that we are now at the end of our 25 minutes. For those of you listening live, we're going to take a few minutes to do a little bit of Q&A. And of course, we always encourage you to contact us. I've got our information right there, Strategic Sustainability Consulting. We are at sustainabilityconsulting.com. Call me or send us an email. We would be delighted to have a longer conversation about what all of this means for you and how to really create a 90-day action plan to really jumpstart an ESG process for you so that you can go, right out of the gate in January, building back better, integrating sustainability and ESG with your recovery plan. Thanks so much.